The bond market has taken a beating this year, the worst year on record for the bond market. Are they undervalued, or are more declines to come? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. It is just astounding to look and look at your low risk investments, your bonds, your intermediate term or even short term bonds, and look at their performance year to date, really over the past couple of years. It is just astounding. This is the biggest drawdown we've seen in the bond market ever. And yes, the bond market technically was created in the 70s, but bonds obviously go back, centuries. But still, this is an unprecedented year, negative year for bond investors. And I've often said this is one of the most frustrating and most challenging things for investors this year. And you might understand, well, the stock market was expensive, and yes, now we're dealing with inflation and the economy is changing, and so yeah, stocks have suddenly dropped. But normally during those times, bonds hold up. They do okay. And bonds have gone down really just in almost the same magnitude. And so now the question is, and I had the video about this recently about, well, is the stock market now cheap? And Reader's Digest version is it's cheaper. I wouldn't argue it's cheap yet, based on historical PE levels and kind of forward PE projections. What about the bond market? A bond market getting beaten up this bad, would you now say, gosh, bonds look attractive, or bonds are cheap? Or do you start looking and saying, gosh, I need to shift these dollars from bonds into cash? Well, to get an answer, it's a little risky, but I'm going to explain a little bit of the technical side of how bonds work. And if you're a CD investor, and I'm not comparing CDs to bonds, but just in premise how they operate. If you're a CD investor, how that works is you're actually taking money that you've saved up and you're lending it to the bank. To a bank, okay? And that bank, you're lending them the money. They're agreeing to pay you interest every, 6 months or a year or whatever. And then after, let's say 3 years, if it's a 3-year CD, they're gonna give you your money back. So in this example, say you lend them $10,000. They're going to give you, say, 3% a year, every single year, $300. And then after 3 years, you're going to get your 10 grand back. That's how it works, okay? And why is that a good deal? Well, for the bank, they can go out and take that 10 grand you lent to them, and they could loan it out to someone else, maybe to buy a car, and charge them 5.5%. So they're going to make a little bit of interest. They're going to pass that interest on to you. That's how it works. With CDs, the reason why I'm bringing this up is we often don't look and see any fluctuation in the value of our CDs. It's just, well, we know, give them 10 grand, I'll get 10 grand back at maturity, and along the way, I'm going to collect interest. Bonds work similarly, okay? When you invest in a bond, you are loaning your money to that corporation. And when you're buying bond mutual funds, you are investing your money in that mutual fund, and that mutual fund has taken that money and lent it out to different businesses. But the premise is the same. It's just typically for a lot longer than 3 years. It could be 10 years, could be 20, could be 30 years, even longer, okay? And how that works is they're then taking that 10 grand or whatever the number is, and they're lending it to Coca-Cola. And Coca-Cola or whomever is going to pay them an interest rate. And say that 10 grand, they're going to lend it out to Coca-Cola. Coca-Cola is going to pay them 5% in interest every single year, maybe every 6 months, okay? But that's an annualized basis. And then 30 years from now, Coca-Cola is going to give that 10 grand back. That's essentially how it works. But along the way, if interest rates go up, and at the time, you've got this contract, you've got this agreement with Coca-Cola that they're going to give you 5%. If interest rates go up and now the prevailing market rate is 7%, gosh, that bond, that contract, that agreement that you have with Coca-Cola where they're going to give you 5%, that's not as attractive because 7% is now the prevailing rate. And so that bond, that value, that $10,000 that you originally invested or lent to Coca-Cola technically is not as attractive. So it might be worth less because interest rates today are above that 5%. Okay? Now, that just means if you were to try to exchange that agreement and give it to someone else, it might be, it's going to be worth a little bit less than that $10,000 because instead of buying your bond from you, that other person could go out and invest in a new bond and get 7%. Does that make sense? Conversely, if interest rates go down and now the prevailing interest rate is 3%, your 5% agreement with Coca-Cola is now more attractive. It actually looks better because that person that might want to buy your bond investment is looking at that saying 5%. Wow, that's great. Today's interest rates are only 3%. So in that scenario, your $10,000 investment might be worth a little bit more because you've locked in, you've got a 5% interest, and when the market is only paying 3%. Whether during that time, if interest rates go up, your bond looks a little less valuable. If interest rates go down, your bond looks more valuable. In either scenario, if you don't sell that bond, if you don't do anything, you'll continue to get your 5% interest from Coca-Cola until 30 years from now or whenever that term expires, and they're going to give you your 10 grand back. All of that market increase or decrease based on interest rate, it really doesn't matter. You can just wait. You can just hold that bond until that stated maturity and then get your $10,000 back. Hopefully that makes sense. That quite possibly could be the worst explanation of how a bond works because I've got no visual effects. I'm not, the production value here is at a minimum, but that's essentially how it works. And with bond investments, I was working with an individual recently who has a sizable net worth, and we've gone out and we've purchased a lot of individual bonds. And it's not appropriate for a lot of folks, but his financial plan, that made sense because of how much resources he has saved up, they have saved up, and how much their spending is. So they've got a lot saved up, they don't spend a lot. Therefore, buying individual bonds, we can buy a lot of them, so we're diversified, and we can structure it in such a way to get a certain level of income, and it fits in his situation. Well, I was meeting with him recently, and the value of those bonds have gone down, okay? And so I just wanted to compare and contrast the environment. And I pulled up what those bonds were actually trading at 2 years ago. And all of them, and so bonds are kind of shown on your investment statement in $100 increments. So going back to that Coca-Cola example, instead of $10,000, well, it's going to be issued at $10,000. It's going to mature at $10,000. When you're looking at bond investments online, something like that, it's $100. So it's going to be the bond is issued at $100 and it will mature at $100 unless that company goes bankrupt, something like that. Okay, so when we were looking, if I looked at this individual's bonds from 2 years ago, all of the bonds were trading around $103 or $105, $104. Some were $117. All of them were above 100. And at that time, we were talking about that, hey, listen, over time, as you get closer and closer to maturity, your values are actually going to be coming down. We know that. You've seen some appreciation because these bonds, these $100 bonds are now worth right now more than $100. We don't need to sell them. We're not planning on selling them because you're still collecting the interest rates and everything looks good. So we understood that at the time. But now, as the aggregate bond market's down 16% year to date and bonds are down significantly, this was a helpful reminder because I showed this individual, here's where they were 2 years ago. And we just scrolled through the list, 103, 107, 117, blah, blah, blah. Where are they now? 91, 93, 94, 87. These $100 bonds that were purchased at $100 and will mature at $100. A couple years ago were worth more than 100. So false capital appreciation there. And today are worth significantly less than what they're going to mature at. If you own a bond fund, you might not have as much sort of tangible transparency, but you can look at the bond fund and look at the average weighted price. And one of the bond funds that we are big fans of, that we use here, the current average weighted price is $91 for that $100 bond. And the maturity on average is about 5 years from now. So if that bond manager, that bond mutual fund manager, just doesn't change anything with their portfolio, those bonds should recover about 10% of the losses that they've experienced this year just by waiting. Still collecting the interest they're going to get, but just by waiting for these next few years. I hope that helps. I take a geeky, logical view to something that might be very emotional right now. If you've got a lot of bond holdings, you likely have been saying these are safe and steady investments. Why have they dropped so much? And you might feel the urge to say, done. Interest rates are going to keep going up because we've got high inflation. The Fed has said they've got to raise interest rates. I'm done with these bonds. I've got to move to cash. I got to stop the bleeding. I would encourage you, before you take that drastic action, that might be the right case, the right thing to do in your situation. You've got to be doing comprehensive financial planning, working with your CFP, because it's very possible, if you look at the underlying values of those bonds, they are temporarily worth less, worth below what they'll mature at, and selling right now may possibly be what would turn out to be a long-term mistake. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.